Hello and welcome you to this month's monthly overview. Got a few things in my mind that I wanted to discuss. So let's get straight ahead. So this is a very interesting view of how the sectoral preferences are shifting over the last month and also over the last 1 year. As you can see, in the last 1 month, there are only a few sectors which has done well. Nifty auto, consumption being and consumer durables being the most prominent among them, and primarily because of the fact that we've seen announcements regarding uh, the reduction of GST, which has also now come through. So after the announcement, the market started rallying for these specific consumption kind of sectors, with the expectation that with the reduction in GST, people are going to have more disposable income to spend on cars, to spend on consumer durables, and on consumption. But in general, if you look, you will see that the large majority of uh, sectors here have been underperforming. And interestingly, within that space, if you see, these sectors like public sector enterprises, realty, uh, Nifty IT, healthcare, they have been underperforming for nearly a year, right? Although in between, I think there was some rally in pharma, but in general, they have been sort of underperforming, or they've not been performing well. If I look at the 1 year performance of these sectors, we'll find that most sectors have not been performing well. So very few have done well, but in general, there has been large, underperformance, or large poor performance, if I may put it that. Over a longer period, of course, this is the post-COVID rally, so obviously the numbers look very impressive. The other interesting aspect or of this shift is this is pretty much the last 1 year heat map, sector by sector. And I'll not go into details, but if you really look at uh, the color shading, you will realize that the greens, which are where the results have been significantly better than the previous month. In fact, the color scales are graded, uh, you know, vertically. So what you will see is the green ones are very few and far between. So it gives us a sense that the market has not been in a very good position over the last few months and few quarters. Now, the reason stock price is ultimately a derivative of corporate performance, and the reason why we see such lackluster corporate performance is primarily because of the fact that sales growth, if you see, has been sort of tapering off, and so has been uh, the PAT and the EPS growth, right? Uh, in between, in the fourth quarter, there was some upward movement of PAT and EPS growth, but again, that has sort of come now back to the Q3 FY25 levels. So basically, earnings growth has been lackluster. This is a cohort of stocks that I sort of track, which is basically 3,000 odd crores market cap and above. So fairly large part of the market, but not really the micro caps and the SMEs. This is the smaller mid caps and the mid caps and the large caps. Having said that, you will also notice that there are some sectors where the earnings growth has been quite impressive this quarter, Q1. So obviously the commodity sector, basically comprising of oil and gas, cement, you know, pipes, those kinds of things. They have done really well. Some metal companies also are in the commodity index. So if you see here a PAT and a EPS growth of nearly 36%. Similarly, chemicals has been an very good performer with 31% kind of PAT growth. Metals have been in a sweet spot, and if I go back to this chart, you will see that those are the spaces where the market has been sort of uh, giving them a good kind of return. So metals have been doing well throughout the year. What is also interesting is that a vast majority, like I just said, of sectors have not performed well. So if you just start moving down, you will find that most sectors have shown less than 10-12% growth, which is not a very good uh, kind of a situation. Now, within that, what is good? In fact, I take this opportunity of doing the monthly reviews, and I look back onto my Twitter feed, because I tend to read a lot of stuff, and I use Twitter uh, as a sort of placeholder for random thoughts, news, etc., that I come across. Uh, so last month, I think that this is perhaps the most important news that we could see. uh, L&T, as every one of you know, it's the bellwether for Indian infrastructure capex. It's the bellwether for manufacturing, for engineering. And when L&T comes up and says that things are picking up in the private sector capex, it sort of raises hopes of sustained economic recovery. Because till date, what we have seen is that the economic recovery has been driven primarily by government capex. So now, if private companies are beginning to come through, then that augurs well for the near term and the medium term future of the overall economy. The other interesting aspect is where the money is flowing. So one large chunk of money flow has been happening into debt mutual funds. So the first time we saw that, we all talk about SIPs going into equities, and very rarely do we actually talk about debt funds. But what we are seeing is that debt funds have also, grown to 20 trillion in AUM in India, and that's a significant number, right? Uh, a large part of it has to do with the fact that we are getting into an uh, lowering of interest rate regime, where which could actually provide some kind of a boost to earnings to long-term bonds and things like that. So obviously there is interest in the debt side of the market. The other interesting aspect, and this is now not specific to India but more of a global, is where are companies finding value, or where are they investing their capex money? And globally, this is a research by Goldman Sachs, and globally they found that companies are intent on putting money in the transition economy. So when I talk about the transition economy, it is basically the sectors or the industries where we are seeing change. And today, in today's world, I think the biggest change is AI. So obviously, if you see, the highest amount of investment is coming through in data centers, followed by renewable energy, energy transmission, semiconductors. So all of this in some way related to the boom in AI and the boom that we are seeing in associated industries. So this is something that we need to keep at the back of our minds when we look for themes of investment for longer periods of time. Uh, Moving on, I think last month I did a video, and I spoke about a new theme which is beginning to emerge, which is nuclear power. And one of the reasons why I do these kinds of studies from time to time is that it helps me to keep focused, or just be cognizant of the new or news flow that comes in that sector. So if I had not done the study on nuclear power, I would probably have missed these kinds of uh, news item that comes through. uh, what we are beginning to see is the thrust uh, from the government, and this is not only happening in India, it is also happening globally. But in India, we are seeing uh, you know proposals from the government to make nuclear power uh, generation much more easier for the private sector, at least to get into that entire end-to-end supply chain. So the proposed changes to the Atomic Energy Civil Liability for Nuclear Damage Act is already under legal review. So once these happen, the the target of moving from 8.8 gigawatts today to the vision of taking it to about 100 gigawatts in by 2047, that is the measures are being made towards that journey. So obviously a journey which takes you 10, 11, 12 fold in terms of growth. And even if you give a 20, 30, 50% discount to the aspiration, so let's assume that even if we don't get from 9 gigawatts to 100, even if we get halfway there to 50, even that is a 5 or more than 5x of capacity that we have currently. So interesting times. The other interesting news item I came across was the US company Holtec and their Indian CEO talking about creating 100 small modular reactors in India. And their perspective is that the Indo-US nuclear power partnership should help us, help both India and US uh, counter the dominance of the Chinese in the power industry right now. So this is again a space which is nascent, which is building up. The whole idea is to continue to keep tabs on it to see how it pans out. The last thing that I wanted to sort of take a look at is I was looking at you know the market sentiment from the purview of IPOs. Uh, Most of you who've listened to me or have read what I write, you would probably be aware that I am not a proponent of IPO investing. I always believe that it is better to give a company at least a couple of quarters of post listing uh, to see how the performance actually plays out. Performance in terms of corporate numbers, quarterly numbers, not only not really the stock price movement. Also, that is equally important in my books. The idea is that experience tells me that when a company comes for an IPO, they tend to sometimes clean up their books, sometimes window dress their books to make it look nice and presentable to the investor community. And a lot of times what we see is just after the IPO, the subsequent quarter results come as a shocker, because a lot of the things that was window dressed uh, once the IPO is over is now dumped on the investor community. So I've always believed that if a story is really good for the long term, it doesn't harm you to wait for a couple of quarters to see how it plays out, and then you can always buy it after a couple of quarters. So when I was looking at the numbers, I actually looked at the listing day performance. So on the IPO listing date, how many stocks closed in profits, how many stocks closed in loss, and what was their average of the listing day gains for that year across all the IPOs. And I looked at both the main board and the SMEs, and it's a very interesting phenomenon, and which I think is obviously somewhat intuitive. So 2019 markets sort of were lackluster, and it is evident in the numbers here. So average listing day gain was negative, and the companies which were profitable at the end of the listing day versus the number of companies which were loss making on the first day was 2:1. So for 41 companies closed in profit and 21 closed in losses. Now if you start looking, go from 2019 onwards, you see that the average listing gain goes from minus 1.4 to 15 to 23 to 26 to 34, and last year it went up to a whopping nearly 51%. And you look at the number of profit to loss making companies, from 2 it went up to 6.2. So for every loss making company there was more than 6 companies which were profit making. And look at where we are today. We are actually back to the 2019 days in terms of the number of profitable to loss making companies. So we are back at 2, although the listing gains have not gone back to negative territory, but it is somewhere here, somewhere maybe in between 2019 and 2020. While at it, I was also looking at the top 10 IPOs which have generated huge investor interest over the last 3-4 years. And on the table on the left is basically the main board listings. The table on the right is the SME board listings. And obviously, if you see, there has been a huge amount of exuberance. Whether it is irrational or not, remains to be seen. But as of now, there's been a huge exuberance in companies in the SME board. So top 10, if you look at the 300% listing gains and over 100% listing gains, compare that to the main board from about 20% to about 90%. But even in the main board, you will find that there has been a lot of companies where the stock price spurt has been significant. So the takeaway from this is really that IPOs, if you look at the previous, go back to the previous slide, you find that IPOs are not always remunerative. If you have a strategy of applying for every IPO and then selling off on first day, that might be an interesting strategy. You would have made very decent returns across all these years. But in general, the thing that happens in real life is, once you apply for an IPO, you may or may not get allotment and things like that. So results will get skewed. I've actually missed putting in the bottom 10 wealth creators or the most wealth destroyers on listing day. That would also perhaps be a very interesting study. But the idea here is to see that there are so many different kinds of companies that has listed over the last 5 years. So companies like Amazon Doc, to Data Patterns, Amber, Keynes, Tega, Indian Renewables, NetWeb continues to do well, Mrs. Vectors. So the option of as an investor that we have after a few years, even if the IPO sort of bombs in the beginning, the benefit is that we get a large number of choices getting added every year. And I think that is the biggest value. That is the celebration of capital markets that we are all looking for. The more vibrant our market is, the better it is for us as the investment community, because over time we get a very diverse set of businesses to choose from. With that, I'll close for today. Thank you. Thanks for listening. Feel free to put in your comments, share your thoughts, and till next time.